Before we dive in, please remember that the content in this video is for educational and informational purposes only. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. All strategies and trades discussed are for illustrative purposes and should not be considered financial advice. Please consult with a licensed financial professional before making any investment decisions. You open up Thinkorswim. You're confident. You know this platform. You've traded stocks, you've navigated complex options chains, you've set up your custom charts. You feel like you own this space. Then, out of curiosity, you click on it, the Forex Trader tab, and instantly everything changes. It's like stepping into a parallel universe. Suddenly, you're staring at a wall of cryptic symbols. Euro to US dollar, pound sterling to Japanese yen, Australian dollar to Canadian dollar. The price quotes have 5 decimal places. There are strange terms like pips, lots, and leverage that feel completely alien. Your comfortable, familiar stock trading world is gone, replaced by a dashboard that looks more like a flight simulator for a spaceship you don't have a license to fly. You feel a wave of confusion, maybe a little intimidation, and you do what most people do. You click right back to the familiar trade tab and pretend you never saw it. If that sounds even remotely familiar, then you are in exactly the right place. Because that experience, that wall of confusion, is the single biggest barrier for thousands of otherwise skilled US-based traders who want to explore the largest financial market on the planet. And let's be clear, trading Forex inside Thinkorswim as a US resident is a unique challenge. The platform is different, the regulations are different, and the information you find online is often geared toward international brokers with completely different interfaces. It's no wonder it feels like trying to solve a puzzle with half the pieces missing. This video series is your missing half. This is the definitive A to Z masterclass specifically designed for you, the US-based trader, to conquer the Forex world inside the Thinkorswim platform. We are going to systematically dismantle that wall of confusion brick by brick. My goal is simple. By the end of this series, you will navigate the Forex Trader tab with the same level of confidence and clarity as you do your stock watch list. You will understand not just what to click, but why you're clicking it. We will transform this intimidating spaceship dashboard into a precision tool that you can use to analyze and engage with the global currency markets. I've spent years breaking down this specific platform not just as a trader, but as an educator obsessed with one thing: making complex systems incredibly simple. I've seen where every beginner gets stuck. I know which buttons cause the most confusion, and I've figured out how to explain concepts like leverage and pip value in a way that actually makes sense for someone coming from a stocks and options background. This isn't going to be a dry, boring lecture. This is a hands-on, practical walkthrough. We're going to build your knowledge from the ground up, starting right now. So where do we begin? Not with a complicated strategy, not with a fancy indicator. We start with the most fundamental question of all. What actually is Forex? And how is it fundamentally different from trading a stock like Apple or Tesla inside this platform? At its core, Forex, or foreign exchange, is simply the act of converting one currency into another. Think about the last time you traveled internationally. You went to the currency exchange booth at the airport, handed them your US dollars and got back euros or pesos or yen. You participated in the Forex market. The exchange rate you got, say $1.10 for every euro, is the price. Now, imagine that happening millions of times per second on a global digital scale, involving trillions of dollars every single day. That's the Forex market. It's the biggest, most liquid market in the world, dwarfing the stock market. But unlike the stock market, you're not buying a piece of a company. When you buy Apple stock, you own a tiny fraction of Apple. When you buy the euro to US dollar pair, you are not buying a piece of Europe. You are making a simultaneous transaction. You are buying the euro and, at the same time, selling the US dollar. You are speculating that the value of the euro will rise relative to the value of the US dollar. It's a financial tug-of-war between two entire economies, and you're placing a bet on which side will pull harder. This is the first major mental shift you have to make. You're no longer trading single tickers, you are always trading pairs. The second massive difference is the clock. The New York Stock Exchange opens at 9:30 a.m. Eastern and closes at 4 p.m. Sleeps. The Forex market does not. Because it's a global market, it operates 24 hours a day, 5 days a week. As the trading session closes in Tokyo, it's opening in London. As London winds down, New York is in full swing. This creates a continuous, flowing market that presents opportunities at all hours of the day and night, a major draw for those who can't be glued to a screen during typical US market hours. Now for the third, and arguably most important, difference for a beginner on Thinkorswim: how price movement is measured. With a stock, it's simple. Apple goes up $1, you made $1 per share. It goes up 50 cents, you made 50 cents. In Forex, we don't talk about dollars and cents. We talk about pips. A pip is an acronym for percentage in point, and it's typically the fourth decimal place in a currency quote. For example, if the euro to US dollar moves from 1.0750 to 1.0751, it has moved 1 pip. This tiny unit of measurement is the bedrock of Forex trading, and understanding its value, which we will break down completely in a later part, is absolutely critical. Trying to trade Forex without understanding pips is like trying to drive a car without understanding miles per hour. Finally, there's the elephant in the room: leverage. In the stock world, you might have a margin account that lets you borrow some money. In Forex, leverage is on an entirely different level. It allows you to control a large position with a relatively small amount of capital. For example, a 50-to-1 leverage ratio, which is common for major pairs in the US, means that for every $1 in your account, you can control up to $50 in the market. This is a double-edged sword. It can amplify potential gains, but it can and will amplify potential losses just as quickly. It is the single most dangerous tool in the hands of an uneducated trader, and it's why we are going to dedicate an entire section of this series to understanding and respecting it. Okay, that's enough theory. Let's get our hands dirty inside the platform. The very first step before we do anything else is to set up our workspace for clarity and efficiency. We need to tame that chaotic-looking screen. Go ahead and open your Thinkorswim platform. Look at the main tabs at the top: Monitor, Trade, Analyze, Scan. All the way to the right, you should see Charts and then Tools. What many people don't realize is that the Forex Trader interface isn't under the main Trade tab where you find stocks and options. You need to go to the Trade tab, and then look for the subtabs underneath. You'll see All Products, Forex Trader, Futures Trader, etc. Click on Forex Trader. What you see now is the default layout. For many, it's a cluttered box of currency pair buttons called the Forex Currency Map. Frankly, I don't find this default view very useful for serious analysis. It's a bit like a toy. We want to build a professional dashboard. So, the very first thing we're going to do is customize it. Look for the little grid icon in the top right of that Forex Currency Map gadget. Click it and select Detach. Now you can close it completely. We want a blank canvas. Our goal is to create a simple, powerful layout. A list of currency pairs on the left, a detailed chart in the middle, and our order entry panel on the right. This is a classic, effective setup. First, let's add a watch list. Go to the bottom left of your screen and click the plus sign that says Create and Itemize Your Gadget List. A menu will pop up. Select Watch List. A new watch list gadget will appear. Now here's the key. Click on the menu icon within that new watch list and go to View. Make sure Forex is checked. This will give you access to pre-made lists of major currency pairs. You can start with major Forex pairs to keep things simple. Now we have our list. Next, we need a chart. Again, go to that plus sign in the bottom left, and this time select Chart. It will pop up. Drag and resize it to take up the main central part of your screen. Finally, we need our order entry tool. This is the most crucial part. Go back to the plus sign one more time and select Dashboard. This gadget is your mission control for placing trades. Drag it over to the right side of your screen. Now we need to link everything together. Look in the top right corner of each gadget: the watch list, the chart, and the dashboard. You'll see a little symbol that looks like a chain link. Click it on the watch list and set it to a color, say red one. Now do the same for the chart. Click the link symbol and set it to the exact same color, red one. And do it one more time for the dashboard. Link it to red one. What you've just done is magical. Now when you click on any currency pair in your watch list on the left, like the pound sterling to US dollar, your main chart will instantly load the pound sterling to US dollar chart, and your dashboard on the right will instantly be ready to place a trade on the pound sterling to US dollar. You've just created a dynamic, efficient Forex trading station from a blank screen. This simple, clean setup is the foundation upon which we will build everything else. You've taken the first concrete step from being intimidated by this platform to being in command of it. Now that our screen is set up and we understand the battlefield, the key differences between stocks and Forex, We're ready to learn the language of this new world. In the next part, we are going to dive deep into the single most important concept you must master before ever risking a single dollar: pips, lots, and leverage. This is the holy trinity of Forex mechanics. It's where 90% of beginners make their most costly mistakes, and we're going to break it down so clearly you'll never be confused by it again. Let's start with the smallest, most fundamental unit of all, the pip. Pip stands for percentage in point, or price interest point. But you can forget that right now. All you need to know is that it's the tiniest change in value between two currencies. For most major pairs like the euro versus the US dollar, or the British pound versus the US dollar, the pip is the fourth decimal place. So if the euro to US dollar is trading at 1.0750, and it moves to 1.0751, that is a 1 pip move. Simple as that. It's the last big number you see in the quote. Now there's a small exception for pairs involving the Japanese yen, where the pip is the second decimal place. But for now, just burn that fourth decimal place into your mind. That's your unit of measurement. It's like an inch on a ruler. But here's the problem. An inch is an inch. A pip on its own is almost worthless. A 1 pip move might be worth a fraction of a penny. You can't build a trading strategy around making a tenth of a cent. It's like trying to fill a swimming pool with an eyedropper. So how do we make these tiny little price movements meaningful? How do we turn them into something that can actually impact an account? That brings us to the second piece of the trinity, the lot. If a pip is the unit of measurement, the lot is the unit of volume. It's the how much. Forex is traded in standardized quantities, or lots, because it's not practical for the global banking system to handle millions of tiny, individual dollar transactions. They need to bundle them. Think about it like buying eggs. You don't go to the store and buy one single egg. You buy a dozen or a half dozen. A lot is just a prepackaged bundle of currency. The industry standard is called a standard lot. A standard lot is 100,000 units of the base currency. So if you're trading the euro to US dollar, one standard lot is 100,000 euros. Now I know what you're thinking. $100,000? I don't have that kind of money to put on a single trade. And you're right. Almost nobody does. Stick with me because we're going to solve that problem in a moment with the third piece of our trinity. For now, just understand the math. Let's connect the pip and the lot. This is the moment where it all clicks. If one standard lot is 100,000 units, and a pip is a move of 0.0001, what is the value of 1 pip move on a standard lot? You multiply them together. 100,000 times 0.0001 equals 10. $10. On a standard lot, for most US dollar-based pairs, a 1 pip move is worth $10. Suddenly, that tiny little fluctuation on the fourth decimal place isn't so tiny anymore. If the currency pair moves 10 pips in your favor, that's a potential $100 gain. If it moves 20 pips against you, that's a potential $200 loss. Now we're talking about real numbers. But maybe $10 a pip feels like a little too much heat when you're starting out. No problem. Brokers offer smaller lot sizes. There's the mini lot. A mini lot is 10,000 units of currency. So what's the math? 10,000 times 0.0001 equals $1. On a mini lot, 1 pip of movement is worth $1. Much more manageable for a smaller account. And we can go even smaller. There's the micro lot. A micro lot is 1,000 units of currency. 1,000 times 0.0001 equals 0.1. 10 cents. On a micro lot, 1 pip is worth just 10 cents. This is where you can learn and test strategies without feeling the financial pressure. In Thinkorswim, you don't select mini or micro from a drop-down. You just enter the number of units you want to trade: 100,000 for a standard, 10,000 for a mini, or 1,000 for a micro. You have total control. So to recap, the pip is the change in price. The lot is the size of your trade. Together, they determine how much money you make or lose per point of movement. But this brings us back to that big, scary problem we identified earlier. Even a micro lot is 1,000 units of currency. A mini lot is 10,000. A standard lot is 100,000. Most people don't have that kind of cash just sitting in their trading account. So how is it possible for regular people to participate in this market? This is where the third and most misunderstood piece of the trinity comes in: leverage. Leverage is a tool. And like any powerful tool, be it a chainsaw or a sports car, it demands respect. Misuse it and you will get hurt. but understand it and it can be incredibly effective. In simple terms, leverage is a loan from your broker. It allows you to control a large position in the market with a relatively small amount of your own capital. That small amount of your own capital is called margin. Think of margin as a good faith deposit. You put down a small percentage of the full trade value, and the broker fronts you the rest. For US-based traders, the maximum leverage on major currency pairs is typically 50 to 1. This means for every $1 you put up in your account as margin, your broker allows you to control $50 in the market. Let's look at our standard lot again, that $100,000 position. With 50 to 1 leverage, do you need the full $100,000? No. You divide $100,000 by 50. You only need $2,000 of your own money set aside as margin to control that full $100,000 position. Your $2,000 is controlling a position that makes or loses $10 per pip. This is how leverage magnifies your potential returns. A 100 pip move in your favor could result in a $1,000 gain on your $2,000 margin. That's a 50% return. Sounds incredible. But, and this is the most important part of this entire video, leverage is a double-edged sword. It magnifies losses just as powerfully as it magnifies gains. That same 100 pip move, if it goes against you, results in a $1,000 loss. That's a 50% loss of your deposited margin on that single trade. You can see how quickly a position can go wrong if you don't manage your risk. Leverage doesn't change the dollar value of a pip. A pip is still worth $10 on a standard lot. What leverage changes is how much of your own money is at risk to achieve that exposure. It shrinks the denominator. It tightens the wire you're walking on. This is the single biggest trap for new traders. They see 50 to 1 leverage and think, great, I can trade 50 times bigger. That is the road to ruin. The professional mindset is, great. This means I only need to tie up a small amount of my capital as margin for a reasonably sized trade, which frees up the rest of my capital to manage risk or diversify. It's a tool for capital efficiency, not for reckless speculation. So how does this all look inside Thinkorswim? When you go to place a trade, you'll see a quantity field. This is where you tell the platform your lot size. You don't type one standard lot. You type in the actual currency units. 100,000, or 10,000 for a mini, or 1,000 for a micro. And here's the beautiful part. You don't have to calculate the margin yourself. Based on the 50 to 1 leverage, when you enter your quantity of 100,000, Thinkorswim will automatically calculate and show you the required margin, that $2,000, that will be set aside from your account to open the trade. It does the heavy lifting for you, showing you exactly how much of your capital is being put on the line as a deposit. Pips, lots, and leverage. The unit of measure, the unit of volume, and the tool that connects them to your account. They are not three separate ideas. They are one single interconnected system for managing position size and potential risk. Understanding this relationship is non-negotiable. You now understand the engine of Forex trading. You know how risk is measured and managed. But knowing how an engine works is different from actually driving the car. In the next part, we're getting behind the wheel. We're going to build the Thinkorswim Active Trader Ladder from scratch and place our very first paper trade step by step. Alright, let's get that dashboard built. First things first, navigate to the Charts tab at the top of your screen. You'll likely see a pretty standard chart, maybe with some volume bars at the bottom. This is our canvas. But to trade Forex effectively, especially if you're looking at shorter time frames, you need a cockpit. You need instant access to your controls. That's where the Active Trader comes in. Look over to the right-hand side of your chart. You should see a small, almost hidden arrow or a button that says Chart Tools or something similar. Click it. A sidebar will expand, and you'll see a few options. We're looking for the big one, Active Trader. Click that and boom. A whole new panel appears docked right next to your chart. This is the ladder. This is our mission control. Now let's break this thing down piece by piece so you understand exactly what you're looking at. In the center, you have a column of prices. This is the ladder itself. The price is moving up and down this ladder in real time, tick by tick. The shaded area in the middle is the current market price, the spread between the bid and the ask. To the left of the price, you'll see a volume column. This shows you how many contracts or units were traded at each specific price level for the day. It's like seeing the footprints of the market. To the right of the price, you have two critical columns, buy orders and sell orders. This is where the magic happens. This is where you place your trades with a single click. Clicking in the Buy Orders column at a specific price sets a buy limit order. Clicking in the Sell Orders column sets a sell limit order. It's intuitive. You want to buy below the current price? Click there. You want to sell above the current price? Click there. Above the latter, you'll see a box for quantity. This is absolutely critical. For Forex, this is not contracts, it's units of currency. The standard lot is 100,000 units. A mini lot is 10,000 units. A micro lot is 1,000 units. Let's start with a mini lot. So in that box, type 10,000. Don't just leave it at the default. Always be intentional about your position size. Next to the quantity, you'll see a drop-down menu that probably says, Single. We'll come back to this. This is where you unlock the true power of this tool. Below that, you'll see a checkbox for Auto Send. I want you to listen very carefully. For now, leave this box unchecked. When Auto Send is on, any click you make on the ladder is an instant live order. There is no confirmation, no "Are you sure?" dialogue. It is a one-way ticket. While professional day traders use this for speed, as a learner, it's a recipe for costly mistakes. We will always use the confirmation window for now. Below the ladder are your big, bold buttons. You've got Buy MKT and Sell MKT. These are your panic buttons or your I need to be in this trade right now buttons. Clicking these will get you into a trade immediately at the best available price. Use them sparingly. Precision is often more important than speed. Then you have two of the most important buttons on the entire platform: Cancel and Flatten. Cancel will cancel any working orders you have, the orders you've placed that haven't been filled yet. Flatten is the eject button. It does two things at once. It cancels all working orders and it closes your current open position at the market price. If the market is moving against you and you need to get out, one click on Flatten saves you from fumbling around. It is your ultimate exit strategy. Okay, so that's the default setup. It's functional, but we're not here for functional. We're here for optimal. We're going to customize this. Go up to the top right of the Active Trader panel, and you'll see a little gear icon for settings. Click it. A window pops up. Go to the Buttons tab. This is where you can design your own trading dashboard. You can see the default buttons here. Let's add a new set. Look for a button that says Add Item or Customize. We want to create a custom order template. This is the technique that separates beginners from experienced traders on this platform. We're going to create an OCO bracket order. OCO stands for One Cancels Other. It means when you enter a trade, you can automatically set a stop-loss order to protect your downside and a take-profit order to lock in gains. If one of those orders gets hit, the other one is automatically canceled. It's your automated risk manager. In the customization menu, we're going to create a new button. For the order type, select TRG with bracket. This means trigger with a bracket order. Now it asks for the details. Let's set up a common scenario. Let's say we want a trade that automatically has a 20 pip stop loss and a 40 pip take profit. This is a 1-to-2 risk to reward ratio. In the settings, you'll see options for the stop loss and the profit target. Instead of a fixed price, change the setting to tick or PIP. This makes it relative to your entry price. For the stop loss, we'll set it to -20 pips. For the profit target, we'll set it to +40 pips. You can even give this button a custom name. Let's call it Buy 20/40ths. Now create another one for selling called Sell 20/40ths with the same parameters. Apply the settings. Now look at your Active Trader panel. You should see your new custom buttons. This is huge. You've just transformed a multi-step, panic-inducing process into a single pre-planned strategic click. Let's put it all into practice. Double-check that you are in paper money mode. I cannot stress this enough. Look for the orange banner. We are practicing. We are drilling. We are not using real capital. Let's pull up a popular pair like the euro to US dollar. Make sure your quantity is set to 10,000. Now let's say you believe the price is going to go up. Instead of just clicking by market, you're going to click your new custom button, Buy 20/40ths. A confirmation window will pop up because we left auto send off. Read it. It should say you're about to buy 10,000 units of euro to US dollar and simultaneously place a sell stop order 20 pips below and a sell limit order 40 pips above. This is your entire trade plan, preloaded and ready to go. Click Send. Now look at your chart and the ladder. 3 things just happened. 1. Your position is open. You'll see it listed at the bottom of the ladder, showing your P/L, your profit or loss in real time. 2. You'll see a line on your chart and an order on the ladder for your stop loss, 20 pips below your entry. 3. You'll see another line and order for your take profit 40 pips above. This is the beautiful part. See those little tags on the chart for your stop and profit target? You can click and drag them. If you want to tighten your stop loss as the trade moves in your favor, you just click it and drag it up. The order is modified instantly. You don't have to go through menus. You are interacting directly and visually with your trade. This is what gives Thinkorswim traders such a powerful edge in managing their positions. Let the trade run for a moment. Watch the P/L fluctuate. Get a feel for how the market moves. Now let's say you've decided to exit the trade. You don't have to wait for your stop or target to be hit. You have complete control. Simply go to that beautiful, powerful flatten button. Click it. Another confirmation window appears. Click send. And just like that, it's over. Your position is closed, and both your stop loss and take profit orders have been instantly canceled. You are flat. You are out of the market, safe on the sidelines, ready for the next opportunity. Take a moment and appreciate what you've just done. You haven't just learned to click a few buttons. You have built a sophisticated, semi-automated trading interface tailored to your own strategy. You've learned how to enter a trade with predefined risk and reward, how to visually manage that trade on the fly, and how to exit with a single click. This is the core mechanical skill of trading Forex on this platform. We've built the dashboard, but a great driver needs more than just a speedometer. They need a GPS, a rearview mirror, and a clear view of the road ahead. In the next part, we're going to transform this basic chart into a professional-grade Forex analysis station, adding the essential indicators and drawing tools that separate the amateurs from the pros. Okay, so our chart is a blank canvas. It's clean, it's functional, but it's not telling us the full story. To get that professional-grade view, we need to add layers of information. Think of it like a pilot's cockpit. A pilot doesn't just look out the window, they have instruments for altitude, speed, and direction. For traders, our instruments are called indicators, and our manual navigation tools are drawing tools. Let's start with the most fundamental indicators. Moving averages. A moving average does exactly what it says. It calculates the average price of a currency pair over a specific number of periods, or candles, and plots it as a smooth, flowing line on your chart. Its primary job is to smooth out the noise of day-to-day price fluctuations and help us identify the underlying trend. Is the market generally heading up, down, or sideways? The moving average gives us a clue. There are two main types you'll encounter: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA gives equal weight to all prices in its calculation period. The EMA, on the other hand, gives more weight to the most recent prices. Why does this matter? In the fast-paced world of Forex, many traders prefer the EMA because it reacts more quickly to recent price changes, which can be critical. Let's add a couple of the most commonly used EMAs to our chart. We're going to go up to the Studies icon, which looks like a little beaker. Click it and select Edit Studies. On the left, you'll see a massive list of indicators. Type Moving into the search bar, and you'll see MOV Average Exponential. Double-click it to add it to our chart. Now we need to configure it. By default, it's set to a length of 9. This is a very short-term average. We're going to set up a classic combination for identifying short-term and medium-term trends. Let's change this first one to a 21-period EMA. Click on the gear icon next to it. In the length input, type in 21. Let's also make it easy to see. Under the Plots tab, let's change the color to a nice, vibrant blue and maybe make the line a bit thicker. Click OK. Now let's add a second one. Go back to Add Study, find MOV Average Exponential again, and double-click it. This time we'll set it up as our medium-term trend guide. Click the gear icon, change the length to 50. For the color, let's pick something that contrasts with blue like a bright orange. Click OK, then Apply. Look at your chart now. You have two dynamic lines flowing with the price. The general idea many traders follow is this. When the faster blue line, the 21 EMA, is above the slower orange line, the 50 EMA, it suggests the short-term momentum is bullish or upwards. When the blue line crosses below the orange line, it can suggest a potential shift to bearish or downward momentum. Price action above both lines is often interpreted as a strong uptrend, and price action below both is seen as a strong downtrend. These are not trading signals on their own, they are trend confirmation tools. They're our compass. Next, we need an instrument to measure the engine's power. the momentum of the market. For this, we'll use an oscillator, and the king of oscillators is the Relative Strength Index, or RSI. The RSI doesn't measure the absolute price. It measures the speed and change of price movements on a scale of 0 to 100. It helps us gauge if a currency pair is potentially overbought or oversold. Let's add it. Back to the studies beaker. Edit studies. In the search bar, type RSI and double-click RSI. You'll see it appears in a separate panel below your main price chart. The standard setting is 14 periods and we'll stick with that. You'll also see two horizontal lines, typically at the 70 and 30 levels. Here's how traders often interpret this. A reading above 70 suggests that the market might be overbought. This doesn't mean you should immediately sell. It's like a car's engine running at a very high RPM. It can stay there for a while, but it's a condition to be aware of. Conversely, a reading below 30 suggests the market might be oversold. Again, it's not an automatic buy signal, but an indication that the selling pressure might be getting exhausted. The RSI is a momentum gauge, telling us about the health and sustainability of a trend. The final indicator we'll add is volume. Volume tells us how much of a currency is being traded over a period. In the decentralized Forex market, this is tick volume, representing trading activity from Thinkorswim's liquidity providers. It's a powerful confirmation tool. A strong price move on high volume is generally considered more significant than the same move on low volume. It's the difference between a crowd cheering and a single person clapping. Back to edit studies. Search for volume, and double-click volume average. This will add volume bars at the bottom of your chart. You can customize the colors to show, for example, green for a bar that closed higher than the previous one and red for one that closed lower. This instantly tells you if the buying or selling pressure is accompanied by high activity. Seeing a breakout above a key price level accompanied by a huge spike in volume can give a trader more conviction in that move. So now look at your screen. We have price action, our trend-following EMAs, our RSI momentum oscillator, and our volume confirmation tool. This is a solid foundation, but indicators are only half the story. They are based on past price. To get a sense of the future, we need to do our own analysis, and for that we need drawing tools. On the right side of your chart, you'll see a toolbar with various icons. These are your drawing tools. Let's focus on the essentials. The most important concept in technical analysis is support and resistance. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Resistance is the opposite, a price level where an uptrend might pause due to a concentration of supply. To draw these, we'll use the horizontal line tool. It might be labeled price level. Click on it. Now look at your chart for obvious turning points in the past. Find a significant peak or a swing high, where the price went up and then sharply reversed down. Move your cursor to the top of that peak and click. A horizontal line appears across your entire chart. That is now a potential resistance level. If the price approaches that level again in the future, traders will be watching to see if it bounces off it again or breaks through it. Now do the same for support. Find a significant valley or a swing low, where the price fell and then bounced back up. Use the price level tool to draw a horizontal line at the bottom of that valley. That's a potential support level. It's crucial to think of these not as exact lines, but as zones or areas. Price might poke through a little or turn just before it. By marking the most obvious peaks and valleys, you are creating a map of the market's key battlegrounds. Next up is the trend line. If support and resistance levels are horizontal floors and ceilings, trend lines are diagonal ones. Click on the trend line tool, which looks like a diagonal line with 2 points. To draw an uptrend line, find at least 2 consecutive significant swing lows, with the second low being higher than the first. Click on the first low, drag your mouse up to the second low, and click again. Extend that line out into the future. This line now acts as a dynamic level of support. In a healthy uptrend, price will often come down, touch this trend line, and bounce off it. For a downtrend, you do the opposite. You find at least 2 consecutive swing highs, with the second high being lower than the first. You connect them with a trend line, which now acts as dynamic resistance. These lines help you visualize the trend's channel and its strength. A steep trend line indicates strong momentum, while a flatter one shows a slower, more grinding trend. Now for the most important step of all. You've just spent all this time customizing your chart, adding your perfect blend of indicators and drawing key levels. You don't want to do this every single time you open Thinkorswim. You need to save your work. First, let's save the indicator set. Go back to the Studies beaker. At the bottom right, you'll see a button labeled Save Set. Click it and give it a name you'll remember, like My Forex Template or EMA Trend Setup. Now, anytime you open a new chart, you can simply go to Load Set and instantly apply this entire combination of indicators. But we can go one step further. We can save the entire layout, the chart, the indicators, the drawing tools, even the color scheme. Go to the top right of your main Thinkorswim window, where it says Setup. Click it, and then select Save Workspace as. Give your entire workspace a name like Forex Trading Station. Click Save. Now, whenever you log in, Thinkorswim will remember everything exactly as you left it. Your analysis on the euro to US dollar, your trend lines on the pound sterling to Japanese yen, it will all be there, waiting for you. You've now built and saved your own personal, professional-grade trading dashboard. But a dashboard is only as good as the information it displays. Now that we have our chart set up, let's dive into the tools that help us anticipate what might happen next. This is where we transition from being a reactive trader, someone who just looks at price history, to becoming a proactive strategist, someone who understands the forces that could move the market in the future. We're moving from the rearview mirror to the forward-looking radar. And for that, we turn our attention to one of the most powerful, yet often overlooked, sections of the entire Thinkorswim platform, the Analyze tab. Click on it, right up top next to Charts. At first glance, it can look a little intimidating. You see things like Add Simulated Trades, Risk Profile, Probability Analysis. It feels like you've walked into the mission control room at NASA. But don't worry. For our purposes as Forex traders, we can zero in on a few key features that will give you a massive analytical edge. Let's start with something that is the lifeblood of currency movements: economic data. In the stock market, you might focus on a company's earnings report. In Forex, you're focused on a country's earnings report. And Thinkorswim has a built-in economic calendar that is second to none. Under the Analyze tab, look for a subtab called Economic Data. Click it. What you see now is a calendar of all major upcoming economic events from around the world. This is your roadmap to potential volatility. You can see the date, the time, the event name, and which country it pertains to. But here's where it gets powerful. You can filter this information. Look for the filter button, usually on the right side. You can choose to see events only from specific countries. As a Forex trader, you'll want to keep the United States, Eurozone, United Kingdom, Japan, Canada, Australia, and maybe a few others checked. This cleans up the noise and lets you focus on the data that will directly impact the major currency pairs you're trading. Now let's break down what you're actually looking at. You'll see a list of events like CPI, non-farm payrolls, GDP, and retail sales. These aren't just random letters. They are the vital signs of an economy. Let's take CPI, the Consumer Price Index. In simple terms, this is the most widely used measure of inflation. It tracks the average change in prices that consumers pay for a basket of goods and services. Why does a Forex trader care? Because a country's central bank, like the US Federal Reserve, has a mandate to control inflation. If CPI comes in higher than expected, it means inflation is heating up. This might pressure the central bank to raise interest rates to cool the economy down. Higher interest rates make a currency more attractive to foreign investors seeking a better return on their money. So a hot CPI report can often lead to a stronger currency. The opposite is also true. A lower than expected CPI report can signal a cooling economy, potentially leading to a weaker currency. Then you have the big one, especially for the US dollar NFP or non-farm payrolls. This report is released on the first Friday of every month, and it's like a monthly report card for the US job market. It tells you how many jobs were added or lost in the previous month, excluding farm workers. A strong NFP number suggests the economy is robust and growing, which is typically bullish or positive for the US dollar. A weak number can signal economic trouble, which is often bearish or negative. The NFP release is famous for causing huge, immediate spikes of volatility in the market. Knowing when it's coming isn't just helpful, it's critical for risk management. You may decide not to enter a new trade 10 minutes before the NFP release, or you might ensure your existing trades have proper stop losses in place. This calendar in Thinkorswim doesn't just tell you the event is happening. It gives you 3 crucial pieces of data for each event: the previous number, the forecast or survey number, and then once it's released, the actual number. The real market moving potential lies in the difference between the actual and the forecast. If the actual number comes in way different than what analysts were expecting, that's when you can see explosive moves in currency pairs. Using this tool, you're no longer caught off guard. You know exactly what's on the horizon. Okay, so that's the fundamental, event-driven side of analysis. But what about a more quantitative statistical approach? Let's go back to the Analyze subtabs and find the one that says Probability Analysis. This is a tool that separates the amateurs from the pros, and it's built right into the platform. What this tool does is it uses data from the options market to calculate the implied probability of an asset, in our case, a currency pair, reaching a certain price by a certain date. It's essentially a snapshot of the market's collective bet on future volatility. It's not a prediction. It's not a crystal ball. It is a statistical calculation of market expectations. Let's walk through an example. In the probability analysis window, you'll see a symbol box. Let's type in a major pair like Euro to US dollar. The platform will load a price chart and a probability curve. You can adjust the time frame. You might want to know the probable trading range over the next 30 days. You can set the date forward by 1 month. Now look at the chart. You'll see shaded areas that represent 1 and 2 standard deviations from the current price. In statistics, 1 standard deviation typically covers about 68% of probable outcomes, and 2 standard deviations cover about 95%. So the tool is telling you that, based on current options pricing, there's a 68% chance that the Euro to US dollar will stay within this inner shaded range over the next 30 days. This is incredibly powerful for a few reasons. First, it helps in setting realistic profit targets. If you have a theory that the euro is going to skyrocket to a certain level, you can check the probability analysis. If that level is way outside the 2 standard deviation range, the market is essentially saying that's a very low probability event. It doesn't mean it can't happen, black swan events occur, but it should give you pause and make you reevaluate the risk versus the reward of your trade idea. Second, it's a fantastic tool for placing stop losses. Many traders place stops at arbitrary levels. But what if you could place your stop just outside the statistically probable range of normal market noise? By looking at the lower boundary of the 1 standard deviation range, you can get a data-driven idea of where a logical stop might be, a level that is less likely to be hit by random fluctuations. You can even drag the price levels on the chart. Place your cursor on a specific price level, and the tool will tell you the exact probability of the currency pair trading at or above, or at or below, that price by your chosen expiration date. It might say probability of touching, 40%, or probability of finishing above, 22%. Let's connect these two analytical tools. Imagine you see on the economic data calendar that US CPI data is coming out next week. You know this will likely cause volatility in the US dollar to Japanese yen pair. You can then go to the probability analysis tool, plug in US dollar to Japanese yen, and set the time frame for just after the CPI release. The tool will show you the market's expected price range, factoring in the anticipated volatility from that event. You're now combining fundamental event awareness with a quantitative statistical model. You're thinking in layers. You're not just trading what you see. You're trading with an understanding of market expectations and potential outcomes. This is the Thinkorswim edge. Many retail Forex platforms give you a chart and a buy and sell button, and that's it. They leave you to fend for yourself. Thinkorswim provides a suite of institutional-grade analytical tools designed to help you build a comprehensive market thesis. It encourages you to ask deeper questions. Why might this currency move? What events are on the horizon? What is the market implied probability of my target being hit? By mastering the economic data calendar and the probability analysis tool, you elevate your trading preparation from a simple hobby to a serious, analytical process. You learn to respect risk, identify opportunities, and ground your trading decisions in data, not just emotion. We've now built our custom dashboard for viewing the market, and we've explored the analytical tools to help us form a trading hypothesis. We have our cockpit and we have our navigation and weather systems. The next logical step is learning how to actually fly the plane. We've built our dashboard, we've analyzed the fundamentals and the probabilities. Now it's time to talk about execution. In the next part, we're going to break down the active trader ladder and place our very first simulated Forex trade step by step, exploring the different order types you absolutely need to know. Alright, let's dive right into the heart of Thinkorswim's trading interface, the active trader ladder. This tool is, for many, the central nervous system of their trading day. It's designed for speed, clarity, and precision, and once you understand its layout, you'll see why it's a favorite for active Forex traders. To get there, make sure you're on the main trade tab, and then click the Active Trader subtab. What you see now might look a little intimidating, like an aircraft cockpit, but let's break it down into simple, manageable pieces. In the very center is the price ladder. This is a vertical list of prices for the currency pair you've selected, like euro to US dollar. The price that's highlighted in the middle is the current market price, constantly ticking up and down. To the left of this price column you have the bid side, and to the right you have the ask side. Remember from our earlier discussion, you sell at the bid and you buy at the ask. Flanking the price ladder are the bid size and ask size columns. These numbers tell you the volume, or liquidity, available at each specific price level. A large number means there are many orders waiting to be filled at that price. Next to that, you'll often see a volume column, which shows you how many lots have actually traded at each price during the day. This can help you identify areas of significant buying or selling interest. But the most important column, once you have a position open, is the P/L open column. This stands for profit and loss on your open position, and it gives you a real-time dollar-for-dollar reading of how your trade is performing. It's the ultimate feedback loop. Now let's get our hands dirty. And I want to stress this again. We are in the paper money simulator. This is not real capital. This is a safe environment to learn, practice, and make mistakes without any financial consequence. It is absolutely critical that you become proficient here before ever considering the live markets. Let's work with the euro to US dollar. At the top of the active trader panel, you'll see a quantity or size box. This is where you define your position size. In Forex, this is measured in lots. A standard lot is 100,000 units of the base currency. A mini lot is 10,000, and a micro lot is 1,000. For learning purposes, let's start with the smallest possible size. We'll type in 1K for 1,000 units, or 1 micro lot. This keeps our simulated risk very small and allows us to focus on the mechanics. The simplest way to enter a trade is with a market order. A market order says, I want to get into this trade right now, at the best available price. The advantage is that your order is almost certain to be filled instantly. The potential downside is something called slippage, where the price you get filled at might be slightly different from the price you saw when you clicked the button, especially in a fast-moving market. To place a buy market order, you'd simply click the big Buy Market button. Let's do that now. Click Buy Market. A confirmation window will pop up. This is a safety feature. Review the details. You're buying 1K of euro to US dollar, and click Send. Instantly, you'll see a few things happen on the ladder. First, your position will appear. You'll see a green marker indicating your entry price. Second, the P/L open column will come to life, showing you a small negative number. Why negative? Because you just paid the spread, the difference between the bid and ask price. Your trade needs to move in your favor enough to cover that spread before it becomes profitable. That was easy, but market orders don't give you control over your entry price. For that, we need a limit order. A limit order says, I only want to buy at this specific price or lower, or I only want to sell at this specific price or higher. You're setting your terms. The trade-off is that if the market never reaches your price, your order will never be filled. Let's try placing a buy limit order. Let's say the euro to US dollar is trading at 1.0750, but based on your analysis, you believe it's a better buy down at 1.0740. You'd go to the active trader ladder, find the 1.0740 price level in the bid column. That's the left side, and simply left-click in the cell. A green buy tag appears. That's your working order. The platform will now wait, and only if the market price drops to 1.0740 will it execute your buy order. To cancel it, you just click the little X on the tag. Now, entering a trade is only 1/3 of the equation. The other 2/3, and arguably the most important, are knowing when to get out, both when you're right and when you're wrong. This is where bracket orders come in, and this is a game changer for discipline and risk management. A bracket order brackets your entry order with 2 exit orders simultaneously, a stop loss to protect you from excessive losses, and a profit target to lock in gains. When one of these exit orders is triggered, the other is automatically cancelled. This is often called an OCO, or one cancels the other order. Let's set one up. At the top of the active trader panel, look for a template drop-down menu. It might say single order by default. Click on it and select TRG with bracket. This means trigger with bracket. Now, when you go to place an order on the ladder, something different happens. Let's say we want to buy if the price breaks above 1.0760. We'll go to the Ask column, the right side, and hover over the price above the current market. This is called a buy stop order, an order to buy once the price rises to a certain level. When we click there, a confirmation window appears, but this time it has 3 parts: the entry order, a limit order to take profit, and a stop order to limit our loss. We can define our profit and stop levels by an offset in pips, a percentage, or a specific price. Let's use pips, since that's common in Forex. We might set our profit target or limit order to be 40 pips above our entry, and we can set our stop loss to be 20 pips below our entry. This gives us a potential risk-to-reward ratio of 2:1, a concept we covered earlier. Once you configure these offsets and click Send, you'll see 3 working orders appear on your ladder: your entry order, your profit target high above it, and your stop-loss order down below it. You've just automated your trade management. You've defined your maximum acceptable loss and your desired profit before you even entered the trade, removing emotion from the decision-making process in the heat of the moment. Let's talk a bit more about that stop-loss. A standard stop order or stop market order is your primary defensive tool. When the market price touches your stop price, it triggers a market order to close your position. Its job is to get you out, period. A slightly more advanced version is the stop limit order. When the market touches your stop price, it places a limit order instead of a market order. This gives you more control over the exit price, but in a crashing market, it's possible your limit price could be skipped over entirely, leaving you in a losing trade. For most cases, a standard stop market order is the more reliable choice for protection. And finally, there's the trailing stop. This is a brilliant tool for trending markets. A trailing stop is a stop-loss order that automatically moves up as the price moves in your favor. For example, you could set a 20-pip trailing stop on a long position. If the price goes up 30 pips, your stop-loss automatically moves up to lock in 10 pips of profit. If the price then pulls back, your stop stays put, protecting your gains. It only moves in one direction, the direction of your profitable trade. Now let's go back to that first market order we placed. How do we close it? The fastest way is the flatten button. This is your emergency exit. Clicking flatten will immediately close any open positions and cancel all working orders for that specific currency pair. It's a clean slate. You can also close a position by simply placing an opposing order. If you bought 1K of euro to US dollar, you would simply sell 1K of euro to US dollar to close the position and realize your profit or loss. By mastering these order types, market, limit, and especially the bracket order with its built-in stop loss, you are building the foundational skills of disciplined trade execution. You're moving beyond just guessing and clicking buy, and into the realm of structured risk-managed trading. Practice this in the simulator. Place market orders. Place limit orders. Set up dozens of bracket orders. Watch how they behave. Get a feel for the mechanics until it becomes second nature. Because once you've mastered the how of execution, we can then turn our full attention to the why and when, which starts with analyzing the charts. And that's exactly where we're headed next. We'll customize our charts, add some of the most essential technical indicators, and use drawing tools to start identifying potential trading opportunities right inside the Thinkorswim platform. Alright, let's dive right into the heart of the platform, the charts. This is where you'll spend most of your time, and making it your own is the first step toward effective analysis. Right now, you're probably looking at a default chart. It's functional, but it's not optimized for you. We're going to change that. First, let's talk about the look and feel. Go to the gear icon on the top right of your chart window, which is the chart settings. A window will pop up. Click on the Appearance tab. Here, you can change everything from the background color to the color of your candlesticks. This might seem trivial, but it's not. Staring at charts for hours can be fatiguing, and choosing colors that are easy on your eyes is crucial. Many traders prefer a dark background, like a charcoal or black, with green for up candles and red for down candles. But you can choose whatever you want. The key is clarity and comfort. You want to be able to glance at the chart and instantly understand the price action. While you're here, make sure Fill Up is checked for your green candles. This makes them solid, which can improve readability for many people. Next, let's go to the Time Axis tab. One of the most important settings here is the expansion area. This adds some blank space to the right side of your chart. By default, the latest candle is jammed right up against the edge, which makes it difficult to project future price movement or draw trend lines. I recommend setting this to at least 50 bars to the right. It gives you breathing room and a canvas to work on. Now let's talk about time frames. At the top of your chart, you'll see options for D, daily, W, weekly, M, monthly, and intraday timeframes like 5 minutes or 1 hour. Switching between these is fundamental. A daily chart gives you the big picture trend over months or years. A 1-hour chart gives you a view of the current trading week. A 5-minute chart shows you the nitty-gritty of the current session. Many analytical approaches involve looking at a higher time frame to establish the overall trend, and then zooming into a lower time frame to look for specific entry points. Get comfortable clicking between these. For our purposes today, let's stick to a daily chart on a pair like the euro to US dollar. With our chart looking clean and our time frame set, it's time to add some analytical power. We're going to add a few of the most common technical indicators. These are essentially mathematical calculations based on price and volume, plotted on your chart to help you interpret the market's behavior. Let's start with the king of all indicators, the moving average. Go to the beaker icon at the top of your chart, which says Edit Studies. This is your indicator library. In the search box, type moving and you'll see a few options. We want simple moving average. Double-click it. You'll see it appear on the right side. By default, its length is 9. Let's change this. Click the little gear icon next to it. We're going to set up 2 common moving averages. Change the length of this first one to 50. This means it will calculate the average closing price of the last 50 candles. Go to the Plots tab and change its color to something noticeable, like blue. Click OK. Now let's add another one. Go back to the beaker, search for Simple Moving Average again, and double-click it. Click the gear icon on this new one and set its length to 200. This is a very widely watched long-term moving average. Let's make its color different, maybe a bold red. Click OK and then click Apply. Now look at your chart. You have 2 lines flowing across the price action. The blue line is your 50-period simple moving average, representing the medium-term trend. The red line is your 200-period simple moving average, representing the long-term trend. Some traders view the price being above both of these lines as a potential sign of a strong uptrend, and below both as a potential sign of a downtrend. When the shorter-term average, our blue line, crosses above the longer-term red line, it's what some analysts call a golden cross. Conversely, when it crosses below, it's referred to as a death cross. These are not predictive signals, but rather historical observations that help traders frame the market's current structure. Next, let's add a different type of indicator, one that lives in its own box below the price chart. This is called an oscillator. Go back to your beaker icon and search for RSI, which stands for Relative Strength Index. Double-click it and hit Apply. You'll now see a new panel below your chart with a line that moves between 0 and 100. The RSI is a momentum indicator. It measures the speed and change of price movements. The 2 most important levels on the RSI are 70 and 30. When the RSI line goes above 70, it's often considered to be in overbought territory. This doesn't mean the price is guaranteed to fall, but it might suggest that the recent upward momentum could be getting overextended. Similarly, when the RSI falls below 30, it's considered oversold, suggesting that downward momentum might be losing steam. It's a tool for gauging market sentiment and can be particularly useful for identifying potential divergences, where the price is making a new high but the RSI is not, which could be a point of interest for some analysts. We've added indicators, but what about our own analysis? This is where drawing tools come in. At the bottom right of your chart, you'll see a small toolbar. If you don't, click the little arrow to expand it. The most fundamental tool here is the trend line. Click on the icon that looks like a diagonal line. Now go to your chart. To draw an uptrend line, find a significant low point, click and hold, and then drag your mouse up and to the right, connecting it to another higher low point, trying to have the line touch as many lows as possible without cutting through the body of the candles. This line now represents a potential area of support for the uptrend. To draw a downtrend line, you do the opposite. Find a significant high, click and hold, and drag down and to the right, connecting it to a subsequent lower high. This line can represent a potential area of resistance. These lines are not magic, but they provide a visual framework for the current market trend. Another critical drawing tool is the horizontal line, which we use for support and resistance. In the drawing tools, find the one that looks like a price level with a horizontal line. Click it. Now look for areas on your chart where the price has repeatedly stopped and reversed, either from going up or from going down. Click on that price level. You've just drawn a line of support or resistance. Support is like a floor that the price has had trouble breaking below. Resistance is like a ceiling that the price has struggled to break above. Identifying these key levels is a cornerstone of technical analysis because they represent significant psychological price points in the market. Now let's take it one step further with a slightly more advanced tool, Fibonacci retracement. Find it in your drawing tools. It often looks like a small rake. This tool helps identify potential support or resistance levels after a significant price move. To use it, you find a significant swing in price from a major low to a major high in an uptrend, for example. Click on the swing low, drag your mouse to the swing high and release. The tool will automatically draw a series of horizontal lines at key Fibonacci levels: 23.6%, 38.2%, 50%, 61.8%, and so on. The theory, as used by many traders, is that after a strong move up, the price will often pull back or retrace a portion of that move before continuing in the original direction. These Fibonacci levels are potential areas where that pullback might stop and find support. The 38.2, 50, and 61.8 levels are often watched very closely by market participants. It's a way of bringing mathematical order to the often chaotic-looking price action. So, take a step back and look at what we've built. We've customized the chart for visual clarity. We've added moving averages to help identify the trend. We've added the RSI to gauge momentum. And we've used drawing tools to mark our own significant levels and trend lines. This is your analytical cockpit. This is your personalized view of the market. You've gone from a blank, default chart to a powerful workspace tailored to your analysis. But here's the thing. You don't want to have to do all of this every single time you open a new chart. That would be a nightmare. So, how do you save this entire layout, your colors, your indicators with their specific settings, and even your drawing tools as a template that you can apply to any currency pair with a single click? And once you have this analysis in place, how do you translate your findings into actual orders? How do you place a market order, a limit order, or the all-important stop-loss order directly from this chart you've so carefully constructed? That's the bridge from analysis to action, and it's precisely what we're going to master next. Alright, let's build that bridge. The fastest, most intuitive, and in my opinion, the most effective way to place orders directly from your chart is using a tool called the Active Trader Ladder. You can enable this by clicking the Active Trader button on the right-hand sidebar. What appears is a column that shows prices vertically, with the current market price right in the middle. You'll see a column for buy orders and a column for sell orders. This isn't just a price display. It's your command center for execution. Let's start with the most basic order type, the market order. A market order says, I want to get into this trade right now, at the best available price. Let's say you've done your analysis on the euro to US dollar, and you're bullish. You believe the price is about to go up and you want to buy immediately. On the Active Trader Ladder, you'll see the current bid price and ask price. To buy at the market, you simply click in the buy column at the current ask price. A confirmation dialog will pop up, you review it and click send. Instantly, you're in the trade. Your position will appear at the bottom of the ladder, showing your P/L, or profit and loss, ticking in real time. Conversely, if you thought the price was going down and wanted to sell or go short, you'd click in the sell column at the current bid price. It's that fast. The key thing to understand with market orders is that you're prioritizing speed over price. In a fast-moving market, the price you actually get filled at, known as your execution price, might be slightly different from the price you saw when you clicked. This is called slippage. It's a normal part of trading, but it's something to be aware of. But what if you don't want to buy at the current price? What if your analysis suggests the price will pull back to a key support level before it continues higher? You don't want to sit there and wait for it to happen. You want the platform to do the work for you. This is where a limit order comes in. A limit order says, I only want to buy at this specific price, or a better one. So, if the euro to US dollar is trading at 1.0750, but you want to buy at 1.0720, you would go to the Active Trader Ladder, find the 1.0720 price level, and click in the buy column right on that row. This places a buy limit order. Your order is now sitting in the market, waiting. If and only if the price drops down to 1.0720 will your order be executed. If it never reaches that price and instead just keeps going up, your order is never filled. You missed the trade, but you also stuck to your plan and didn't chase the market. The same works in reverse. If you wanted to sell, but only at a higher price, you could place a sell limit order above the current market price, anticipating a move up to a resistance level before a potential fall. Limit orders give you control over your entry price. Now let's talk about the single most important order for managing your risk, the stop loss. A stop loss order is your predefined exit strategy if the trade moves against you. It's the mechanism that helps manage potential losses and prevents one bad trade from causing significant damage to your account. Let's go back to our buy order at 1.0720. Once that order is filled and you're in the trade, you need to decide at what point you'll accept that your analysis was wrong. Maybe you decide that if the price drops to 1.0690, the uptrend you were expecting is invalidated. So you would place a sell stop order at 1.0690. If the market turns and hits that price, your stop order becomes a market order, and it automatically sells your position to get you out of the trade. This happens automatically whether you're watching the screen or not. It's your automated discipline, your safety net. For a short position, it's the opposite. If you sold at 1.0780, you would place a buy stop order above your entry, say at 1.0810, to buy back the position and cap your potential loss if the price unexpectedly rises. Placing an entry order, then a stop loss order, and then a take profit order separately works, but it's inefficient and can be risky in a fast market. You might get your entry filled, but before you can place your stop, the price moves violently against you. This is where the true power of Thinkorswim's order entry system comes into play with bracket orders. This is a professional level tool that you have at your fingertips. A bracket order allows you to place your entry order, your stop loss, and your take profit limit order all at the same time, in one single action. At the top of your active trader ladder, you'll see a drop-down menu for order templates, likely set to single order. Click on it. You'll see several options. The one we're interested in is TRG with bracket, which stands for trigger with bracket. When you select this, the interface changes slightly. Now, when you go to place your initial entry order, whether it's a limit or a stop, the platform knows to automatically attach two other orders to it. One stop loss order below your entry and one limit order, your take profit, above your entry. These two exit orders are linked in what's called an OCO relationship, which means one cancels the other. If your take profit target is hit, your position is closed, and the stop loss order is automatically canceled. If the trade moves against you and your stop loss is hit, your position is closed, and the take profit order is automatically canceled. You'll never have a stray, forgotten order left hanging in the market. You can customize the parameters of this bracket right in the interface. You can set the distance of your stop loss and your take profit from your entry price. You can define this in pips, which is the standard for Forex. For example, you could set up a template that automatically places a 30 pip stop loss and a 60 pip take profit every time you enter a trade. This allows you to predefine your risk-to-reward ratio before you even click the button. You've made your trading plan, and now you're just telling the platform to execute that plan with precision. You also need to set the time in force, or TIF. GTC means good till canceled, and it will keep your orders working day after day. Day means the orders will expire at the end of the trading session if not filled. For Forex, which trades 24 hours a day, GTC is very common. Now, here is where it all comes together visually. Once you place that bracket order, look at your chart. You'll see horizontal lines appear directly on the price action. There will be a line for your entry order, a red line for your stop loss, and a green line for your take profit. This is not just a static display. This is a dynamic, interactive control panel for your live trade. Let's say the price is moving in your favor, and you decide you want to lock in some of your gains by moving your stop loss up to your entry price, creating a risk-free trade. You don't have to go into an order menu, cancel the old stop, and create a new one. You simply click on the red stop loss line on your chart and drag it up to your desired level. Let go, confirm the modification, and it's done. See the price approaching a new resistance level and want to adjust your profit target? Click and drag the green line. This ability to see and physically manipulate your live orders directly on the chart is an incredibly powerful feature. It connects your analysis directly to your execution in a seamless, visual way. And what if your entire trade idea changes? The market sentiment shifts and you just want out right now. You don't want to wait for your stop or your limit to be hit. At the bottom of the active trader ladder, there's a big red button that says, Flatten. Clicking this button will instantly close any and all open positions you have for that specific currency pair at the current market price. It's your one-click exit for any situation. So, we've gone from simple market orders to precise limit orders, to essential risk management with stop losses, and finally to the efficiency and power of automated bracket orders. We've seen how to manage these trades not in some clunky menu, but visually by dragging and dropping them right on our charts. We've mastered placing orders on a single currency pair. But Forex is a market of relationships. The euro doesn't move in a vacuum. It moves relative to the dollar, the yen, the pound. How do you monitor multiple pairs at once, see their relative strength, and execute trades across them without having 10 different charts open? There's a specialized tool for that inside Thinkorswim, a command center built specifically for the Forex trader. And in the next part, we're going to build it out from scratch. Alright, let's build that command center. The goal here is to create a single, unified workspace where you can monitor multiple currency pairs, analyze them on different time frames, and execute trades without ever leaving the screen. This is about efficiency and control. First, navigate to your Charts tab. By default, you're probably looking at a single chart. Look to the top right of that chart just below the main tabs. You'll see a small square icon. It looks like a grid. Click on that. This is where the magic starts. You'll get a drop-down menu with different grid layouts. You can choose a 2x1, a 2x2, a 3x3, whatever fits your monitor and your trading style. For this walkthrough, let's choose a 2x2 grid. It's a fantastic starting point. Instantly, your screen splits into 4 separate chart windows. Now they're probably all showing the same symbol, which isn't very helpful. Our first task is to assign a unique currency pair to each window. Let's say you're a trader who focuses on the majors. In the top left window, click inside the symbol entry box and type in Euro to US dollar. In the top right, type in US dollar to Japanese yen. Bottom left, let's do pound sterling to US dollar. And in the bottom right, maybe a commodity currency like Australian dollar to US dollar. Now you have a 4-pane window, a dashboard view of the major market movers. But we can do better. A professional trader often looks at the same pair on multiple time frames to understand the overall trend and find precise entry points. So let's reconfigure this. Let's dedicate this entire grid to just one currency pair, but view it from 4 different angles. In the top left chart, set the time frame to daily. This is our high-level strategic view. Tells us the big picture story. In the top right chart, set the time frame to 4-hour. This is our tactical view, showing us the intermediate trend. In the bottom left, let's go down to a 1-hour chart. This is for seeing the structure of the current day's price action. And finally, in the bottom right, set it to a 5-minute or 15-minute chart. This is our execution time frame, where we look for specific entry and exit signals. Now, all 4 charts are showing Euro to US dollar, but across 4 critical time frames. You can see the daily trend, the 4-hour pullback, the 1-hour consolidation, and the 5-minute breakout all at the same time. This is called multiple time frame analysis, and this grid makes it incredibly intuitive. But here's the problem. What if you want to do this for US dollar to Japanese yen? Do you have to manually change all 4 charts every single time? Absolutely not. That would be tedious and slow. This is where we introduce the concept of linking. Look at the symbol entry box in each of your 4 chart windows. To the left of it, you'll see a small colored icon. It might look like a little chain link or a symbol. By default, it's probably gray, meaning it's unlinked. Click on that icon in your top left chart and choose a color. Let's pick red, number 1. Now go to the other 3 charts and do the exact same thing. Click the link icon and set them all to red, number 1. What you've just done is tell Thinkorswim that these 4 windows are now part of the same team. They are connected. Now go to any one of them, it doesn't matter which, and type in a new currency pair like pound sterling to US dollar and hit enter. Watch what happens. All 4 charts instantly update to pound sterling to US dollar, while maintaining their unique time frames. Your daily, 4-hour, 1-hour, and 5-minute charts all switch in perfect sync. This is a game changer. With one single action, you can perform a deep multi-time frame analysis on any pair you want. We've built the visual analysis part of our command center. Now we need the execution and monitoring tools. Look to the right-hand side of your screen. There's a sidebar that can be expanded by clicking the arrow. This is where we'll add our gadgets. If you don't see it, there might be a small arrow in the middle of the right edge of your screen. Click it to pop it out. At the bottom of this sidebar, there's a plus sign button that says, Add Gadgets. Click that. We need to add a few key components. First, and most importantly, find the Forex Trader gadget. This is the specialized order entry interface we looked at earlier. Add that to your sidebar. Next, add a watch list. This will be our navigation menu for the entire Forex market. You can also add Active Trader, if you like the latter interface, and I highly recommend adding the News gadget to stay on top of economic releases. Once they're added, you can drag and drop them to rearrange the order. I suggest putting your watch list at the top, then the Forex Trader gadget right below it, and News at the bottom. Now, here comes the most critical step of the entire process. Just like we linked our charts, we need to link these gadgets to our charts. Look at your watch list gadget. In its title bar, you'll see that same link icon. Click it and set it to the same color we used for our charts. Red number 1. Now do the same for the Forex Trader gadget. Find its link icon and set it to red number 1. Let's pause and understand what we've just created. We have a 4-chart grid for multi-time frame analysis. We have a watch list to monitor all our favorite currency pairs. And we have the Forex Trader tool to place our orders. And all of them are now linked together on the red channel. This is your mission control. Let's see it in action. Go to your watch list. Click on US dollar to Canadian dollar. Instantly, all 4 of your charts snap to US dollar to Canadian dollar, showing you the daily, 4-hour, 1-hour, and 5-minute views. At the same time, your Forex Trader gadget also updates to US dollar to Canadian dollar. The big buy and sell buttons are now armed and ready for that specific pair. You see the current bid/ask, the spread, everything you need. You can now fly through your analysis. In a matter of seconds, you can cycle through your entire list of pairs. Click on Euro to Japanese Yen. Boom, the entire workspace updates. Click on NZD/USD. Boom, everything is now focused on the Kiwi. You've eliminated dozens of clicks and removed the potential for errors, like looking at a Euro to US dollar chart, but accidentally placing a trade in the pound sterling to US dollar order window. Here it's impossible. The system is unified. The final crucial step is to save this masterpiece. If you close Thinkorswim right now, you might lose it all. Go to the top right of your screen, where you see the Setup button. Click it, and then select Save Workspace As. Give it a memorable name like Forex Command Center or My FX Dashboard, and hit Save. Now every single time you log in, you can go to Setup, click your saved workspace name, and this entire layout will load perfectly, exactly as you left it. You can create multiple workspaces. Maybe you want one layout for trending markets and another for ranging markets with different indicators. The possibilities are extensive, but this core concept, a flexible grid of linked charts connected to a linked watch list and order entry tool, is the foundation of efficient trading inside Thinkorswim. You've moved from having a simple chart to having a fully integrated trading environment tailored specifically for the needs of a Forex trader. You're no longer just looking at the market. You're interacting with it from a position of power and clarity. Now that you have this professional-grade mission control built, the final piece of the puzzle is understanding how to execute with precision. It's not just about hitting buy or sell. It's about using the right order types to manage your entry, your stop loss, and your profit target all in a single fluid motion. It's about letting the platform manage your trade, so you can focus on finding the next opportunity. And that's exactly what we're going to master in our final part. We'll take our new command center and learn how to deploy advanced bracket orders that can fundamentally change the way you manage risk and reward. This is where the rubber meets the road. It's the difference between a trader who is constantly reacting, glued to their screen, heart pounding with every tick of the chart, and a trader who operates like a strategic general, deploying their plan with precision, and then stepping back to let the battle unfold according to preset rules of engagement. That general is you, and bracket orders are your automated field commanders. So what is a bracket order? In its simplest form, it's a 3-part harmony of execution. You have your main entry order, the one that gets you into the trade. But it doesn't go in alone. It's immediately bracketed by 2 other orders that are dormant, waiting in the wings. One is a limit order, placed above your entry if you're buying, or below if you're selling. This is your profit target. The other is a stop order, placed below your entry if you're buying, or above if you're selling. This is your stop loss, your non-negotiable exit point if the trade moves against you. The magic is in how they're connected. They are what's called an OCO group, which stands for one cancels other. If the price moves in your favor and hits your profit target, that limit order executes, and it automatically cancels the stop loss order. Conversely, if the price moves against you and hits your stop loss, that order executes, and it instantly cancels your profit target order. You are taken out of the trade either for a planned profit or a planned loss. There's no indecision. No, should I take profits now? No, maybe it'll turn around. The decision was already made when you were calm, rational, and objective, before you even entered the trade. Let's build one right now. We're back in our command center, looking at the active trader ladder. This is the most intuitive place to launch these orders. Look to the top of the ladder, next to the quantity box. You'll see a button that likely says Single Order. Click that drop down. You'll see a few options, but the one we want is Trigger with OCO Bracket. Select that. Suddenly, your interface changes. When you hover your mouse over the bid or ask column, you're not just seeing one potential order line anymore. You're seeing three: a central line for your entry, a green line for your limit, profit, and a red line for your stop. The platform is now armed and ready to take your complete trade plan in a single click. But we can make this even more powerful. Instead of manually placing these three lines every single time, we can create a template that automatically calculates our profit and stop distances for us. This is the key to consistency and speed. Go back to that same drop-down where you selected Trigger with OCO Bracket. Right below it, you'll see a small gear icon for settings. Click it. A new window pops up called Order Template Editor. This is where we define our rules of engagement. On the left, you'll see your bracket orders, a limit order for the profit target and a stop order for the stop loss. Let's focus on the limit order first. To the right, you'll see how its price is calculated. By default, it might be set to last X plus increment. We want to change this. Click the drop-down that says LNK for link. Let's link it to our entry order, which is the buy or sell order. Now we need to define the offset. Let's say we're trading the euro to US dollar pair, and we want to set a 40 pip profit target. In the Forex world on Thinkorswim, 1 pip is typically represented by a value of 0.0001. So, a 40 pip target would be an offset of 0.0040. In the box next to the plus sign, you would enter 0.0040. Now let's do the same for the stop order. Click on it, link it to the same entry order. But this time, since it's a stop loss on a long trade, it will be a subtraction. Let's say we want a 20 pip stop loss. In the offset box, we'd enter 0.0020. So we now have a plan. For every trade we enter, the system will automatically place a profit target 40 pips away and a stop loss 20 pips away. This creates a potential risk-to-reward ratio of 2:1, a common metric many traders follow. Before you close this window, look at the bottom left. There's a button that says Save as Template. Click it and give it a memorable name. Something like EURUS2:1 or 40 pip target. Now click Save. Look back at your active trader ladder. That main drop-down now has your new template available. Select it. From this moment forward, every time you click on the bid or ask column to place a trade, that entire three-part structure, entry, 40 pip profit target, and 20 pip stop loss, is sent to the market in a single click. The amount of mental energy and potential for error this saves is monumental. You're no longer fumbling to place your stop after you're in a live trade. It's all done simultaneously. But what if you want to let your winners run? What if a trend is so strong that a fixed 40 pip target feels limiting? This is where we can introduce an even more dynamic tool, the trailing stop. Let's go back into our template settings. Click that gear icon again. This time, instead of the stop order, let's change its type. Click the drop-down that says Stop and change it to Trail Stop. Notice the parameters change. A trailing stop doesn't sit at a fixed price. It sits at a fixed distance from the current market price. Let's set the trailing stop amount to 20 pips, or 0.0020. Here's how it works. You enter a long trade. Your initial stop is placed 20 pips below your entry, just like before. But as the price moves in your favor, say it goes up 10 pips, your trailing stop also moves up 10 pips, maintaining that 20 pip distance from the new higher price. If the price goes up 30 pips, your stop moves up 30 pips, effectively locking in 10 pips of profit. The stop can only move in one direction, in your favor. It will never move back down. The trade only ends when the price finally reverses and pulls back by your preset trailing amount, in this case 20 pips from its highest point. This is a powerful method for potentially capturing the lion's share of a strong trend, while still adhering to disciplined risk management. You could save this as a new template, EURUS trailing. Now you have a choice. For a ranging market, perhaps the fixed target template is more appropriate. For a trending market, the trailing stop template could be the tool for the job. You're building an arsenal of strategies, ready to deploy based on market conditions. And with that, we've come full circle. We started this journey looking at a default, cluttered Thinkorswim platform that felt overwhelming. We stripped it down and then we rebuilt it, piece by piece, into a clean, efficient command center designed for one purpose: clear and decisive Forex trading. We learned to read the currency map, to set up our charts for multi-time frame analysis, to build watch lists that filter out the noise, and to use the active trader ladder not just for entry, but for sophisticated trade management. You now possess the operational knowledge of a platform that professional traders use every single day. But knowledge is only potential power. The real journey, your journey, starts now. It starts in the paper trading mode, practicing these setups. It starts with placing dozens, even hundreds of bracket orders on a simulated account until it becomes second nature. It's about personalizing these layouts, making them your own, and developing a workflow that fits your unique trading style. The platform is no longer an obstacle. It's your ally. The charts are no longer a mystery. They are your map. And your trade execution is no longer an emotional reaction. It's a pre-planned, disciplined process. You have the tools. You have the knowledge. The next step is to forge it all into experience. Take what you've learned in these 10 parts, open up the platform and start building. Start practicing. The path to becoming the trader you want to be is now finally clear.